I'm going to do an example of what happens when your S corporation that was previously operated and taxed as a C corporation makes a distribution, how that flows through the process of determining whether the distribution is a taxable C corporation dividend now that you're an S corporation. And so for some more background on this, I did another video that kind of outlines the concept of making distributions when your S was previously a C, and what I call the different buckets: the accumulated adjustments account, the accumulated E&P from the C corporation years, and then the other adjustments account. And so that's what this example builds off of. So I would encourage you to go back and take a look at that video if you don't have any background to this. But otherwise, if you kind of know some of the terminology that I'm talking about, you might find this example helpful to think through the effect of these issues. So the example that I have, I'm going to have a character named Ted, and we'll say Ted was 100% owner of a corporation, and that corporation had $3,000 of accumulated earnings and profits before the corporation made an S election. And then after making an S election, let's say in year one, he earned $8,000, not he, the corporation, now that it's an S corporation, earned $8,000 of taxable income. Let's say that income flowed through to Ted's personal tax return, and then there was also $1,000 of municipal bond interest that happens to be tax exempt for federal purposes, for federal income tax purposes. So the total income of the company for year one was $9,000, $8,000 was taxable, $1,000 was not. That all flows through and is considered on Ted's personal income tax return in the first year that the company is an S corporation. Now let's say that in year X2, the second year of this company being an S corporation, the S corporation actually breaks even. There's no income or loss in this year. But Ted takes $14,000 of cash out, and that's structured as a distribution from equity. Well, how is that $14,000 treated in this circumstance? The way it works when you think about the buckets that I talk about is that you've got a accumulated adjustments account bucket, which is your income earned when you were an S corporation. So the $8,000 that was taxable income earned while this company was an S corporation is in the accumulated adjustments bucket. So of the $14,000 distribution, $8,000 comes from that bucket. But the entire $14,000 can't come from that bucket because it only has $8,000 in it. So we exhaust that bucket down to zero, and we took $8,000 out of that bucket, and that covered that part of the $14,000 distribution. The next thing that happens is you move over to the next bucket, which is the C corporation accumulated earnings and profits that existed before the corporation elected S. And let's say that that bucket had $3,000 in it. So we've exhausted $8,000 out of the accumulated adjustments account, and now we take $3,000 out of the accumulated earnings and profits bucket. So that's 8, 9, 10, 11. I have to do math on my fingers. So that's 11,000 out of the 14,000 that has been accounted for. Okay, that accumulated E&P goes to zero. It can't be below zero. That's it. You've used it. That's that bucket. So if we've only accounted for 11,000 of the $14,000, we still have 3,000 more to account for, right? So the next thing we do is we move over to the next bucket that we call the other adjustments account. And that bucket is where the $1,000 of tax exempt income was thrown into. And so now that we've exhausted the accumulated adjustments account and the accumulated earnings and profits account, now we can take it out of the other adjustments account. So we take the $1,000 out of the other adjustments account. And so now we had $8,000, $3,000, $1,000. So that accounts for $2,000, or excuse me, $12,000. That accounts for $12,000 of the total $14,000 distribution. So the remaining $2,000 of the $14,000 isn't affected by this analysis. If you want to know what happens with that extra $2,000, you would have to go and consider how does that relate to the shareholder's stock basis. If the shareholder still has stock basis to take that $2,000 against, then it wouldn't be taxable. But if that shareholder didn't have any stock basis left, then that extra $2,000 would be taxable on that basis. Okay, So in the above analysis, I'm really kind of avoiding an in-depth discussion about that last $2,000, because what I really cared about for the purposes of this example was understanding how much of that $14,000 distribution would be considered, due to this company previously being a C corporation, a taxable C corporation dividend. So we know that the $3,000 of that 14 came from the accumulated E&P bucket, so that is our taxable dividend on this. That $3,000 is taxed as a dividend. It doesn't actually tell us what happens with the rest of the 11,000 either, right? I said the remaining 2,000, but actually if we want to be really technical with it, we now know 3,000 was a taxable dividend, but of the 14,000, that's 11,000 remaining that we know in theory came out of the AAA bucket and the accumulated other adjustments account bucket. But you have to think about context. Those buckets were only, from a technical standpoint, relevant to determining what was a taxable C Corp dividend or not. They're not actually technically relevant to determining anything else. So all we would know if we kind of put blinders on and don't know any other tax rules is we would say, well, based on just this analysis, 3,000 is a corporate tax dividend from when they were a C Corp, and the remaining 11,000 needs to be analyzed further. But again, that 11,000 is analyzed against TED's stock basis, and what you would probably find is that there are mathematical relationships between the accumulated adjustments account and the stock basis, and so you could probably guess that that a lot of that $8,000 that came out of the accumulated adjustments account, TED probably would have had stock basis for, and so that probably isn't taxable. But when I make that kind of guess, I am jumping into other tax law, and I'm just using my mathematical knowledge of how two different tax laws work in the same way. And so, yeah, this is just a convoluted way of saying that if I'm very regimented, if I'm very structured in my thought process about just thinking through one tax law, one tax issue at a time, I set that whole analysis aside and I just consider the C corporation dividend question. And to that question, I would say, well, 3,000 is taxable as a C corporation dividend. The 11,000 still has to be analyzed against stock basis. Okay, I discuss distributions and basis as topics in other videos on S corporations. I hope you check out my other S corporation videos, because I think if you kind of look at them all together, they will make more sense over the long run. But I broke them into these, what I think are more digestible chunks for you all to take your time with. I'm going to get back to it. Thanks. See you later.